Hello, and thanks for joining me today for this video where we're going to cover what do you actually need for a down payment to purchase your new home. There's a ton of myths online saying I need 20% down before I can buy a home, which can put it out of reach for many home buyers. So today we're going to disprove the myth that you need 20% down to purchase your new home because it's simply not true. And that goes for first-time home buyers as well as move-up buyers or second-time buyers in the process. Thanks for joining me today. If you're new with this channel, my name is Mike Spindler. I'm a mortgage broker with Edge Home Finance, and I've been in the mortgage industry for just over 25 years, which is a long time. In those 25 years, I've helped thousands of clients purchase their new home or refinance their existing home. And I love working with clients and I love moving them through the process, fighting for them, and helping you realize the dream of home ownership or the dream of lowering your monthly payment if you already have a mortgage through refinancing your existing home. So I want to start this video off with a story of a client that I worked with for a 2 to 3 year period, looking to buy their first home. So they were first time home buyers and they were really focused on what they need for their down payment and saving up enough money to bring their monthly payment down to what they feel like it should be in the price range that they were shopping in. And I was educating them for the simple fact that the information that you read online stating you need at least 20% down to purchase a home is simply not true. You don't need that. And it doesn't matter who you are, buying your first home, second home, etc. That's not true. You don't need to save that much down. So anyway, these clients decided to hold off. So I explained to them, you're a first-time home buyer. You can put for conventional financing as little as 3% down, or if you qualify for FHA financing, as little as 3.5% of the purchase price down for your down payment, and then explain to them what closing costs were. And closing costs can range from 3% of the purchase price to 5% of the purchase price, depending on what that actual purchase price is, and depending on how expensive property taxes and state local taxes fees are in terms of what the closing costs will be for you. So I was explaining to them that typically in the price range they were shopping in, we would need about 6% down. And these clients were looking for a $300,000 to a $350,000 house, and they had that money saved up, and that was great. But they decided they were getting advice from other family members and different friends, people from outside the transaction who kept telling them, save more. In the long run, it's going to help you out, which it may if you want to do that. But in their situation, they didn't end up buying a home for 2 to 3 years after we initially connected, and I was walking them through the process and meeting with them, answering questions over that next 2 to 3 year period on homes. And what we did, they did save up more for a down payment, which was good. But as we moved through those 2 to 3 years, the home prices from the home they could have purchased with the money that they already had saved up, if they would have moved forward right away, that same home 2 to 3 years later was 5 to 10% more than the price they could have got it for when we initially started talking, which that's pretty significant when you're talking about a $300,000 to a $350,000 home, because that $300,000 to $350,000 home then went to closer to $400,000 or even more. So even though they were saving up more money to put down on the mortgage, which gives you a lower loan balance, they're actually paying a lot more for the house, which did the opposite of what they were hoping. Their mortgage payment was actually higher when it came time to purchase that home, even though they saved up more of a down payment to put it down, because that price of the home, the same home they could have purchased if they would have bought right away, actually went up pretty significantly over that 2 to 3 year period. I always like to start this off, especially this topic, because this is one of the biggest myths and one of the biggest conversation points that I have with people who are looking to purchase their first home, thinking they need to save more for a down payment, when simply it's not true. Homes will appreciate once you purchase them. Typically, I can't say that's not guaranteed, because as we saw in the early 2000s, we actually saw home prices decline due to the foreclosure crisis, etc. But we haven't been in a market like that with risky mortgage programs for a very long time. One thing that economists are saying is that we should see a steady increase, sustained increase of home values every single year between 1.5 to 5%, depending on the actual market and where interest rates are. So I really want to help you avoid making a mistake and waiting, because the cost of waiting can be pretty significant, especially if the market continues to heat up and we see home values continue to appreciate and increase. Because when it comes down to it, you're probably better off purchasing right now with the little down payment that you have instead of waiting and saving more for the future. Okay, Mike, that sounds great, but what do I actually need for a down payment? So that's a really great question, and that's why I'm glad we're watching this video, because there's a couple things that determine how much you need to put down. So your monthly debt to income ratios, and that is where we take your total monthly debts plus the new estimated house payment and match that against your monthly gross income and see what percent that is. That's called your debt to income ratio. So typically you want to be at 48% or below. You're very comfortable with a home payment and monthly debts with a debt to income ratio below 40%. But some people need to push it a little bit higher into that 40-45% range to get the home that they really want. That's perfect for them, and they know this is my home and this is going to be my home for a long time. So credit score, your debt to income ratio, and down payment dictates which mortgage program you go with. And the two main mortgage programs here in the United States are conventional financing and FHA financing. So let's start with conventional financing. For a first-time home buyer, your conventional minimum required down payment is 3% of the purchase price. So if you're looking at let's say a $300,000 home, 3% of the purchase price for a down payment is going to be $9,000. Then we talk about you have a down payment, and then you have your total cash to close, which is your down payment plus the estimated closing costs. So closing costs, like I said earlier, depending on the purchase price of the home, are going to be between 3 to 5%. Typically in that $300,000 to $350,000 range, you're looking at 3 to 4% of the purchase price for closing costs and prepaid expenses. So if you're looking to purchase your first home, you're a first-time home buyer, and you want to use conventional financing if you qualify for it, then you can estimate realistically, I'm going to need 6 to 7% of the purchase price to put down. And that's down payment plus closing costs plus prepaids. So that's everything that you need to put down. You don't need to have 20% down. The only benefit of doing 20% down, and many can argue that even if you have 20% down, it's not always smart to put the full 20% down and exhaust all of your reserves that you have built up. But the one benefit to putting 20% down is you avoid what's called private mortgage insurance, or PMI. PMI is insurance for the lender in case you default on the mortgage when you put less than 20% down. And you pay it monthly with your monthly mortgage payment, and it goes to the servicer, and it's kind of a protection. Mortgage insurance used to be a lot more spendy, and I think that's where that you need to have 20% down to buy a home myth really came into play, because it was a little more expensive if you put less than 20% down. But now there's so many different private mortgage insurance providers that we do the shopping for that. That's nothing that you have to shop around for, or nothing you're able to shop around for. The lender has to contract that with the company through the underwriting process. And all the companies are very competitive with each other because they want the business. So instead of it being $200-300 a month, now it may be $70 or $80 a month, depending on how much you actually put down. And mortgage insurance is based on percent of down payment buckets. So you have 3 up to 5% down is a certain percentage that gets charged, and then 5 to 10% down, 10 to 15% down, and then 15 to 20% down. And the more that you put down, the cheaper that mortgage insurance gets each month. So that's conventional financing. 3% if you're a first-time home buyer, 3% down plus the closing costs and prepaids. If you're a second-time home buyer, so you're considered a first-time home buyer if you haven't owned a home within the last 36 months. So even if you owned a home more than 3 years ago, and it's been more than 3 years since you sold that property and your name was removed from ownership from the title of the property, you are considered a first-time home buyer again. And you can take advantage of the first-time home buyer programs. But if that's not the case and you're a second time home buyer, you're a move up buyer, you're selling your current home or keeping it for an investment property, and you want to purchase your new home that you're going to live in, then your minimum down payment goes up to 5% of the purchase price. So not a huge difference, 2% more than if you were a first time home buyer. And you can expect the same estimate for closing costs, somewhere between 3 and 5% of the purchase price, depending on what that purchase price is. The higher purchase prices, you can get lower, closer to that 3% in closing costs, but the lower loan amounts, the closing costs as a percentage is a little bit higher because there's still taxes and different things that you have to pay. So that's for conventional financing. And then there's FHA financing. And again, what dictates which program we're going to use is each individual is different. Your credit profile is different, your income profile is different, your down payment profile is different, etc. So we talked conventional. Now with FHA, your minimum required down payment is 3.5% of the purchase price. And then the same closing cost percent estimates apply. So 3 to 5% of the purchase price. So conventional and FHA financing are very similar in what they need for minimum required down payments. And of course, with every program, you can put as much down as you want. So if you have more funds and you want to put it towards the mortgage, you can definitely do that. But a good rule of thumb to use when you're deciding how much should I really put down is every $10,000 additional that you put down towards the mortgage is only going to really change your mortgage payment about $65 a month. So that's why I say one of the biggest mistakes is people put that full 20% down if they have the funds, is because it's not going to get you that much lower of a monthly payment. There's not a huge bang to your buck when you're talking about $10,000, where we can look at your credit reports. And if you have, let's say, credit card balances, or maybe you have an auto loan or some student loan debt, whatever it may be, we can look at that and say maybe that $10,000, putting that to pay down some credit cards may save you $200, $300, $400 a month. So it's always about what's the best financial decision for you in your specific scenario, and what can we make those funds work the best for you with. Is it paying down some debt, or is it truly putting down more of a down payment? Hopefully that helps out understanding what the minimum requireds are to use for the down payment. And the next thing, let's cover what are closing costs, because I know there's a ton of questions surrounding this. And again, with closing costs, there's a lot of misinformation online. Okay, so we know what the down payment is. So down payment funds go directly towards the mortgage. So purchase price, let's say $300,000, you have 3% down, that's $9,000. So you have a purchase price of $300,000, and then you're going to have a mortgage balance of $291,000. That $9,000 is the down payment towards the mortgage. Then we have the closing costs and the prepaid items. And those are the ones that range between 3 to 5%, typically between 3 and 4% is where we see them fall, unless property taxes are super high and uncommon to the area. So what are closing costs for? What do they pay for? So that's a good question. Closing costs, there's a few different slices within closing costs and what they are. And closing costs can be a little bit misleading because just under half of that 3 to 4 to 5% that we're talking about for closing costs, just under half of it is prepaid items. And that's prepaid for homeowners insurance. It's prepaid for property taxes, because when you own a home, you're going to have homeowners insurance. And you're also going to have pay property taxes, because there's property taxes for the home. And then prepaid interest. So that's what we call prepaids. And that accounts on any transaction about 40% of the total closing costs. So those are prepaid items. Those are the cost of owning a home. You're going to pay those every single year, and interest accumulates every single day of the month, and that's what you make your mortgage payment for. It goes towards principal on the loan balance, and it goes towards interest that accrues every single day on the mortgage. Those are the prepaid items. Again, that consists to about 40% of the total closing costs. And then the actual costs and fees. So there are three slices. One is lender fees. How much does your lender charge you to purchase this home? Me being a broker, I can quote no lender fees, where typically the typical lender, you're going to see anywhere from $1,500 to $3,000 for just lender costs. And this isn't called buy down costs. These are hard costs that the lender charges on every single file. I'm a broker, and I don't have to pay for multiple office buildings. I don't have to pay for multiple levels of leadership. I don't have to pay commissions for my management staff, etc. So there's a lot of A lot of reasons that lenders have to charge those fees to keep the lights on and keep the business moving forward. Me as a broker, I don't have those costs. So we don't have any lender fees. So you have lender fees and then you have third-party service fees. So these are what you pay for credit reports, appraisals, flood zone determination to make sure the home's not in a flood zone. If it is, you'll be required to have flood zone insurance, third-party processing fees, etc. So third-party fees. Then the next group is title fees. So when you purchase a home, you'll have a title company that's working for you as well, similar to how a mortgage lender works for you and getting the financing together. The title company prepares the deed. They look at the chain of title or the history of the title of the property to make sure there's no liens against the property that aren't satisfied before you purchase the home. So making sure all the liens are paid off so you don't get stuck with a bill that you didn't know was out there. And then they do the closing and recording with the county as well. So they sit with you at the closing table, you sign all your final mortgage documents, and then they record that sale and those title documents, ownership deed documents with the county, with the state that you live in, showing you are the owner of that property moving forward. So you got lender fees, third-party fees, and title company fees. The last slice is any government fees. So in Minnesota, and a lot of states are the same, when you purchase a home, there's some taxes that you pay to purchase a home in that state. So that's the fourth. That's a smaller portion to the first three, but that's what makes up closing costs. So you have actual costs that are what we just covered in closing costs, and then you have prepaid items that are items that you pay because you own the home. So they're not actual fees. That money is going towards something, and it will continue to do that as long as you own the home and as long as you make your mortgage payments. And then finally, Mike, what does this all mean? When I get to closing, how much am I going to have to pay at closing? So when we talk about purchasing a home, let's say you're doing the 3% down plus closing costs of 3%. So you have 6% for your total down payment and total cash to close, which is down payment plus closing costs and prepaids. So when you make an offer on a home, typically it's customary to put down what's called earnest money. So that earnest money, normally, depending on how much competition there is in making offers on the home, sometimes you want to get a bit more competitive and put more earnest money down. But earnest money typically is 1% of the purchase price of the home, is what you put down for earnest money. That money gets held by the seller's real estate agent brokerage in their trust account. And that money is sent to the title company for closing. So they're holding that basically in good faith that they accepted your offer, you're going to purchase the home. They're going to hold that earnest money until you get to closing. Now at closing, that earnest money, that 1%, let's say it's $3,000 for a $300,000 house that you're buying, that 1% is sent to the title company, and that cash goes towards your total down payment and cash to close number. So that $3,000 will be deducted off that total cash to close number. Everything else when you come to closing, 3 days, 5 days, 7 days before you have your scheduled closing date, your lender should provide you with a balanced final closing disclosure. They call them CDs for closing disclosure. So your balanced final closing disclosure will show every single fee that you pay for closing costs, every single prepaid item for property taxes, homeowners insurance, and prepaid interest that you have, and it'll have them broken out line by line. It'll also show your earnest money deposit, and then all those calculations added up, down payment, closing costs, prepaids, minus the earnest money, equals the total cash to close that you have to bring to closing. In advance of your closing, your lender is going to give you that final balance closing disclosure, or CD they'll refer to it as, and that's the number that you either have to, depending on your title company, wire the funds to them from your bank account to the title company for closing, or you'll go to the bank, get a cashier's check, so a certified check from the bank for that amount in down payment, and then you sign that over. You make the check payable to the title company. You sign that over to them at closing, and then they track all the funds. So the reason I don't receive any money as we're going through the process, you never pay me earnest money, down payment funds, closing costs, that never goes to your lender. That always goes to the title company, because the title company is the party that's working on behalf of the lender and the closers to disperse those funds to that the mortgage has sent to them to use. So what your mortgage is pre-approved for, your purchase price, those funds go to the title company. The title company then pays off the seller, and the seller's title company pays off their mortgages and liens on the property. Um, and then they disperse those funds back to the lender. So that's how it kind of works. You don't need to know those details. Basically, all you need to know is I need this amount of money based on my balanced final closing disclosure, and this is going to be written out to the title company. They handle everything from there. You'll know what those numbers are because your lender, at least me anyway, I know some don't. They just email them out and expect you to understand what that closing disclosure is. But we'll go through it section by section, line by line if needed, and get you comfortable with that number. And then when you go to closing, you're going to see a lot of the same documents you've already signed. You're going to see that same closing disclosure with the exact figures that we covered before you got there. And you're going to sign the paperwork. You're going to get your keys, and you're a homeowner. Hopefully that helped out explaining what a down payment is, how much you need for a down payment, why when they say 20% down, you need that, otherwise you can't buy a home, is a complete myth. If you have any other questions, please feel free to reach out to me directly. Again, I'm Mike with Edge Home Finance, been in the business for over 25 years and helped thousands of clients purchase a new home and refinance their existing home. My direct number is 612-590-8623. Be happy to just schedule some time, no pressure consultation, answer any questions you have, and help you move on to the point where you're ready to get pre-approved and purchase your new home. If you have any ideas or anything that I didn't cover, please reach out to me. Call me, text me, email me. My contact information will be below, and I can create a video and post it on here. Thanks for joining me today. Thanks for watching this video. I'm here to help you whenever you need anything, and we'll see you at the next video.